Today, we're exposing one of the biggest traps in the market: inducement zones. These sneaky price levels are like bait, carefully placed by big institutions to lure retail traders into bad positions. If you've ever entered a trade only to watch price reverse right after, chances are you fell into one of these traps. But don't worry. In this video, I'm going to break down how inducement zones work, why they exist, and how you can avoid getting caught. Understanding this can be the difference between getting played and playing smart, so make sure you stick around. Let's get started. Inducement zones are also called liquidity zones. They are areas where traders get tricked into entering or exiting trades because of the way liquidity is structured in the market. These zones act like magnets, attracting buy and sell orders in a way that benefits big players rather than retail traders. When price approaches these areas, you'll often see high levels of buying or selling activity, making them critical points to watch. But here's the key. These zones don't just appear randomly. They can signal whether the market is about to reverse or continue in its trend. Understanding how to read them properly can give you a major edge in your trading. Now, let's take a closer look at accumulation inducement on the left side of the chart. We see that price accumulated for a while, moving sideways and building up orders. This type of movement traps both buyers and sellers, making them anxious for a breakout. Then boom, price suddenly breaks below the accumulation zone. At this point, sellers jump in, thinking the market has finally gained momentum for a strong drop. But here's where the trap gets them. Instead of continuing down, price aggressively reverses back up, completely wiping out those sellers who got tricked into entering too early. What actually happened? The market makers used that break below to induce sellers and grab liquidity before sending price in the real direction, straight to the upside. The result? Sellers are stuck, stop losses are hit, and now price is moving away without them. This is a classic example of how smart money uses accumulation zones to trap traders before making the real move. Let's shift our focus to the right side of the chart, where we see a bullish triangle pattern forming. Pattern traders are closely watching this setup, waiting for a breakout above so they can jump in on what looks like a strong bullish move. And then, price makes the move. The breakout happens, buyers rush in thinking the market is ready to explode upwards. But here's the trap. Almost instantly, price rejects hard and drops straight down, leaving those buyers completely stuck and confused. What actually happened? This was a fake-out move designed to induce traders into buying at the worst possible time. Market makers pushed price above the triangle just enough to trigger buy orders, only to reverse sharply and take out their stop losses. The lesson here? Don't blindly trust every breakout. Instead, wait for confirmations and be aware of these liquidity traps that big players use to shake out retail traders. Where do inducement zones appear? Inducement zones don't just show up randomly. They tend to form in specific areas of the market. One of the most common places are order blocks. Order blocks are zones where large institutional orders have either been executed or are still waiting to be filled. Because these areas hold a high concentration of liquidity, they often act as prime hunting grounds for market manipulation. This is where the deception happens. Market makers and big players create fake moves, either pushing price up or down, to trick traders into entering the wrong way. They might fake a breakout or make it look like a reversal is happening, only to flip the market in the opposite direction. Understanding this trick can save you from falling into the trap and help you align your trades with smart money rather than getting played by it. Let's dive deeper. Let's take a closer look at how inducement plays out in real market conditions. In this case, price is making a series of break-of structure moves to the upside, creating multiple bullish order blocks along the way. Everything seems to be lining up for a continuation, right? Not so fast. Here's what happens next. 1. Price shows a small pullback, making it look like a perfect buy setup. 2. Instead of respecting the upper order block, price drops sharply, sweeping liquidity from traders who placed buy orders too early. 3. This drop triggers stop losses resting below, trapping retail traders while institutions scoop up liquidity. 4. Once the liquidity grab is complete, price reverses from a lower order block and shoots up with strong momentum, continuing the bullish trend. This is a classic example of how inducement works. The market sets up an obvious move, only to take out early traders before moving in the real direction. Recognizing these traps can help you avoid unnecessary losses and trade smarter. Inducement doesn't just happen around order blocks. Trend lines and channels are also prime hunting grounds for market manipulation. Many traders rely on these structures for entries, expecting a clean breakout or rejection. But here's the catch. Market makers know this and use it to trap both buyers and sellers before moving price in the real direction. Now, how does the market manipulate trend line breaks? When price breaks a trend line, it often creates a sense of urgency. Traders rush in, thinking they're about to catch a strong move. However, market makers intentionally create false breakouts to trigger stop losses and fuel liquidity before reversing price. Imagine price has been respecting a bullish trend line multiple times. Each time it touches the upper trend line, buyers enter, expecting another rejection. Meanwhile, sellers waiting for a breakout confirmation to go short. Then, out of nowhere, a large bearish candle suddenly breaks below the trend line. What happens next? 1. Buyer stop losses get triggered as price moves below the trend line. 2. Breakout traders enter short positions, thinking the trend is reversing. 3. Market makers absorb all this liquidity, then reverse price upward. Here's how to avoid these fakeouts. 1. Don't chase breakouts. Wait for confirmation, such as a retest of the trend line. 2. Be cautious of sudden momentum spikes. If a breakout happens too quickly, it could be a liquidity grab. 3. Look at the bigger picture. Are there liquidity zones nearby? Is the move aligning with higher timeframe analysis? By recognizing these liquidity traps, you can avoid being manipulated and position yourself with smart money instead of against it. Next is support and resistance levels. Inducement isn't just limited to trend lines and order blocks. It's also heavily used around key support and resistance levels. These are some of the most watched areas in the market, making them the perfect battleground for market manipulation. Market makers understand that retail traders love breakouts and reversals around these zones. So, they create false moves to trick traders into jumping in before flipping the market in the opposite direction. Support and resistance levels are often seen as buy or sell zones. When price approaches these areas, traders expect a reaction, either a strong bounce or a breakout. But this is where smart money plays its game. Take a look at what happened here. Price approaches the resistance level, and immediately buyers enter the market, anticipating price to reject to the upside. However, price breaks the support level and rejecting multiple times. This induces sellers to enter short positions, thinking it's a clean break. And this seems like a strong sell zone, right? That's exactly what market makers want you to think. Retail traders see this as confirmation and start placing sell orders, expecting price to drop. But then price suddenly pushes higher, hitting all their stop losses. And there you have it, traders. Inducement zones are one of the market's sneakiest tricks. But now you know exactly how they work and how to avoid getting trapped. 1. Order blocks, where smart money tricks traders before reversing. 2. Trendline and channel breaks, fake breakouts that lure traders in. 3. Support and resistance traps, where retail traders get manipulated. 4. Swing highs and lows, liquidity grabs designed to wipe traders out. The key takeaway? Don't take the bait. Instead, think like the big players, wait for confirmations, and trade with smart money. If you found this video helpful, drop a like, subscribe, and let me know in the comments. Have you ever fallen for an inducement trap? Thanks for watching, and as always, stay smart, stay profitable.